about Africa 50, for example. If we talk about, for example, Africa 50, it focuses on project development, equity investment, mobilizing over $80 billion across 29 countries. AFC, African Finance Corporation, has invested more than 13 plus billion in 166 projects, include rail corridors, renewable energy, and special economic zone. When it comes to healthcare, the pandemic, COVID-19, exposed the fragility of Africa's health systems. So there is a need for long-term capital to build hospitals, diagnostic labs, health tech infrastructure. Pension funds and sovereign wealth funds should invest in healthcare, REITs, triple P hospital projects, and regional pharma hubs. We're also, another very is the digital connectivity. We have in Africa more than 600 million Africans that remain offline. Investment in fiber networks, data centers, and digital ICT systems are critical to close and this digital connectivity program and address this issue. The DFIs and sovereign wealth funds should and what should they do? They can co-invest in digital infrastructure funds like those supported by, as I said, Africa 50. We have also the climate resilience and green infrastructure. That's another challenge. Africa contributes the least to global emissions, but is the most vulnerable among the continents. The financing gaps in Africa exist mainly in renewable energy, climate smart agriculture, and green transport. This should be addressed via instruments like green bonds, blended finance vehicles, and impact-linked loans that can mobilize also capital. So to sum up, I think Africa faces a persistent infrastructure gap, as I said, up to 108 billion, particularly in energy, transport, digital connectivity, and healthcare. Those sectors are foundational for inclusive growth, yet remain underfunded. As I said, sovereign wealth funds, DFIs, and pension funds can play a catalytic role by co-investing in bankable, impact-driven projects, especially those through platforms like Africa 50 and AFC, which are designed to accelerate project development and mobilize private capital.
Thank you. Thank you so much, Mohamed. And I'm glad while you are speaking, Grace figured he needs to record this because there's a whole lot of good data that came out of that. So thank you very much for that. I want to ask Josephine to touch on that and almost segue into one of the issues that happens in terms of the perception of risk. And Josephine, I'd like you to relate a bit because you're seated in one of the biggest pension funds in East Africa, and of course, it's the biggest in Uganda. How do you see the issue of it supporting the growth, and how can it play a catalytic role, especially considering the challenges that come with regulation of where it invests?
Thank you, Francis. Now, as Mohamed mentioned, one of the critical gaps, in my opinion, would be infrastructure and internet connectivity, because according to the African Development Bank report, the need is over 100 billion annually. And when you look at internet connectivity, over 60% of Africans don't have access to reliable internet connectivity. So those are gaps that, if we collaborated, we could be able to fix. But coming back to NSSF Uganda, we are, yes, as you mentioned, we are the biggest pension fund in East Africa. Our assets are now about $7.5 billion, and about 2 billion of that is invested across East Africa. So in investing across the region, one of the biggest hurdles that we have found is the regulation. First of all, our own local regulations does not allow us to invest outside East Africa. So already we have a hurdle as a pension fund to go outside East Africa. So if we can harmonize that, if regulators can allow pension funds to invest all over East Africa, then that creates opportunities that we can tap into, and a way that we can also support Africans. The other thing that I would like to tackle is NSSF is a defined contribution scheme. What that essentially means is that the member bears the risk of any investment that we make. And what that means is that in any investment that we make, we have to be very prudent about the risk. So when you look at infrastructure projects, and especially the ones that are supporting economic growth and government growth, the risk that comes with that is very high. And then on the flip side, we have government bonds that are in double digits. So that, in essence, creates, what should I call it, a conundrum, because you have government bonds, government securities that are offering you a very high return at a low risk. And then on the flip side, you have development projects that are providing impact and growth to the economy, but the risk embedded in that is very high. So what regulators can do, and what I would suggest, is that we should find a way of de-risking these projects. For example, like providing guarantees so that pension funds like ourselves, who care about the risk because our member bears any risk that we take, who care about the risk that is embedded in all these investments, can also be able to participate, because we are willing and we've had conversations, and our ask is that we need a platform where we can de-risk. And I believe if we can collaborate as pension funds all over East Africa, we can be able to push for that. Not just East Africa, but Africa at large. We can be able to push for a platform where the pipeline is large enough with bankable projects that we can all invest in and balance return with the risk. So thank you, Francis.
Thank you so much, Josephine. And you've mentioned a number of things that I want to wonder when you're talking about what you feel are the critical gaps in financing, including the sectors, and also just the risk of perception. I'd like you to combine it with when you look at what in social media, where Rob Stangram was argued that collaboration must come first. And there are issues in terms of trust. I know Josephine said we need to work together on that, but there's issues in terms of trust and coordination. So as you answer that, I'd like for you to touch on that, including collaboration, and also the issue that Josephine has raised, that governments are basically crowding out other opportunities, and pension funds are choosing to invest in government securities. Maybe if you can touch on that, and then we proceed from there.
Right, thanks, Francis. I think this is quite an interesting conversation, and it bears a lot of paradigm shifts, I think, in terms of thinking as far as we are concerned. You know, if you're on a platform where charter holders are sitting and we are supposed to be the solution to the problems that our continent is facing, it demands that we think differently. And this is what I like about the charter. It gives you that ability to see things in a different perspective. So if you look at Africa, I mean, it's quite an interesting but sad story. 34% of our roads in Africa are accessible, only 34%. And the rest of the other parts of the developing world, you see close to maybe 50% or so and higher, but only 34% of our roads are accessible. And the transport costs are definitely 100% higher than in most places. So just talk logistics and the ability to be able to deliver on certain mandates. From a logistics perspective, we already have that barrier that we have to deal with. You consider energy, roughly 30% of our populations in Africa have access to electricity. And it's quite an interesting bit, because of our 1.4 billion people, 40 to 54% of them are living in urban areas. And only 30% of these have access to electricity. And the urbanization rate is quite fascinating at the moment, because it's growing at about 3.5% per annum. So 3.5% of these populations are moving into urban areas annually. And then this has happened in the last 24 years. So if you do the numbers, it's a scary scenario, because you have 34% energy available. And I mean, the other bit is almost every other African country has a housing backlog close to about 1.5 million units. And Nigeria on its own needs 17 million units. And if you just assess where we sit from an energy perspective, we are the only continent that has got about 300 days of sunshine that's available to us annually. But we have the lowest investments in those areas. Consider agriculture, 60% of our people are employed in agriculture, on the continent. And Africa holds 65% of all the cultivated arable land. So the opportunities are very visible. If you look at it, I mean, agri contributes only about 16.5% of the continent's GDP, but employs 60% of the people. The yields, even when we do our agri activities, our yields are only 41% of what everyone else across the world achieves. So our yields are low. So all these are gaps. And one fascinating fact that I picked up, this continent produces about 69% of the world's cocoa, but it only benefits from 2% of the world's chocolate revenues. These are skilled areas where, if you talk about digital connectivity, I think Josephine mentioned things like that. So these are the things for me, when we look at them, they demand that we think differently, because these are opportunities, there are returns there, and there are ways in which we can actually start taking advantage of these opportunities before we go. Because investing in these opportunities is two-pronged. The returns are there for the institutional investors, but at the same time, also the impact for Africans is very clear. So we need to have frameworks that allow institutional investors, particularly pension funds, DFIs, sovereign wealth funds, to have comfort in taking advantage of these opportunities. I was thinking, when Josephine was mentioning the idea of governments crowding out funding, one of the biggest risks Africa sits on is inflation and currency devaluation. And fixed income instruments are the highest prone to this. So pension funds are piling into an area where our risk is highest. Yes, the returns could be high, but on a net return in real terms, are we really getting sufficient returns from government securities? So those are some of the things. And if you look at the average age of the African population, 19.2 years, that's our average age. Let's assume someone goes to work at 24 and they retire at 60. So we have 36 years that we have of savings, retirement savings, that could be used for other things if you look at it from the perspective of pension funds. And all these are being piled into investments that are prone to inflation. So that kind of investment time horizon from our training demands, real returns. And these returns are only going to come from other spaces. So we talk of private equity, we talk of infrastructure, we talk of commingled funds that invest in these spaces that we are talking about. This is the place that's going to bring the return we are looking for as far as institutional investment is concerned. But can we get ourselves comfortable is the question. And who is going to make it comfortable? Because I will tell you the Southern Africa experience from where I come from. We actually need to go and suggest, and policy making is not going to happen in a way that favors us if we are not involved. So our absence on most of these tables has also created a very big gap. So regulations are being crafted, policies are being made in our absence that affect the way we do work, and we are not participating. So I think it's high time societies like the East African CFA, East African Society, you need to sit down. We need to sit down and engage governments. Here we are toying around with the idea of crafting a law that says all investment issues are handled by people that have got certain qualifications, and the charter order is critical as one of those things. So there's, in our own country, there's going to be an act that says investment issues have to be handled by someone who at least holds a charter. So I think it's our absence in some of these places that's then giving rise to the risks that we have been seeing, and we need to make a stand and ensure that we are present. I think that would be my initial response to that. From a coordination perspective, I suppose if platforms are going to allow us, like what Mohamed says, we have 54 countries. And one of the biggest cases that we carry as a continent for our 1.4 billion people is borders. Why do I need a passport? If you're in Europe, you drive across at any point in time and whatever. But when you're in Africa, you need gates and portals and stamping and immigration office. If you take all these immigration costs, put them together, I'm sure we could actually invest in a very significant infrastructure project. But that's what we have been exposed to. And I think we need to start moving differently as far as that is concerned.
Thanks, Don, and I like the impassioned argument. So I'm actually going to throw it back to you. So what do you think would be the practical innovations? What should we do next? Whether it's deal structuring, it's risk sharing, it's partnerships, what should we do next, like to unlock? Because I completely agree, the opportunities are humongous. The risks are there, but it's not for a lack of opportunity. It's for a lack of, like you said, coordination. But what do we need to do? I know you've said that as societies, we need to be to do more advocacy, which is a very key thing with all the African societies and pretty much all the CFS societies globally. Advocacy is one of the key things that we have to keep doing. And we've done it, at least in East Africa, we've seen it in Nigeria, in South Africa also. And Morsy will tell us a little bit about Egypt. And you can see that the regulators are starting to listen. We've done changes in East Africa, which involved some of our members just having the advocacy hat worn and pushing for these changes. But then what should be the real, what is that one or two or the three things that should be done to, which are practical innovations to just unlock this?
I'm thinking one of the things that's critical is alignment of mandates. Most of the mandates that we carry, if we are holding funds on behalf of institutional investors, they well, I don't know how to put this across, but we have a lot of Eurocentric thinking embedded in the way that we craft even the mandates themselves. You know, they are designed to solve European type of retirement solutions if you're in the pension fund setup, and you have African retirement models that need African solutions, but we are, you know, just taking templates and we are putting them in there. So I'm thinking even in terms of the mandates that we have, we need mandates that have a lot more collective and social impact, you know, feel attached to them, so that in the way that we are investing on behalf of all these, you know, whether it's a DFI, it's a sovereign wealth fund, we have, you know, the continent at heart. So I believe most of the mandates that we carry in most of these institutional investors are very misaligned. They don't have the continent's progress at heart. And I'm also looking at, you know, just the idea of creating collaborative platforms where opportunities are shared. Most of the times, opportunities that are within Southern Africa are rarely accessible to someone who's in East Africa. And opportunities in East Africa are also not accessible, probably maybe to someone who's in West Africa. So I suppose because we sit at that point of intersection as charter holders, a charter holder sitting in West Africa, sitting in Southern Africa, sitting in East Africa, North Africa, is not someone who's really, you know, somewhat foreign to these kinds of thinking. So I think our societies also need to have these kinds of platforms where opportunities are available, and we discuss collaborative ways in which so our advocacy needs to actually also be very structured. So when we are advocating, what's informing the advocacy? What are the problems that we intend? If we centralize these problems and we know them to be African problems, then our advocacy then is a bit more focused. So I still believe we are doing advocacy, but I think it needs to be a bit more tailored for Africa. Those could be some of the things that I've noticed which could work in our favor.
Thank you. Thank you so much, Tawanda, for that. I want to just take the same conversation and move to Josephine. And in one of our papers today, I think it's today or yesterday, we saw one of the leading investors or one of the investors in Uganda investing in a bank in Kenya, and it was such big news. So I guess we've started exploring regional investments. Unfortunately, it wasn't the pension fund. So I know Uganda is the NSSF, Uganda's NSSF. There's a restriction on what you can actually be able to explore. But what lessons would you say stand out, particularly regulatory enablers, considering the challenges you're facing, stakeholder alignment, and what could be the guide for future cross-border initiatives? What can we be able to do so that we can be able, as Kenya, as Zimbabwe, or maybe even Egypt, access these investments from NSSF Uganda?
Thank you. Thank you, Francis. We do invest in East African banks. you are aware that in Kenya we have investment in most of your big banks. But back to the question. So when you look at the environment, how to basically catalyze investment in East Africa, as Tawanda mentioned, we need to develop mandates that are for Africa. Because if I have, for example, a simple thing as withholding tax is something that could go a long way in supporting us investing across different countries in Africa. Because if pension funds had faced the same tax environment across Africa, that's already a barrier gone. That's already an incentive. That's already something that we can now spread out our wings and go across Africa. The other thing would be us as charter holders, as investors, as let's say NSSF. There are some things that we can do and we scale out. For example, NSSF did something called the High Innovator Project. So that program is a program where we partnered with MasterCard Foundation to provide, basically to create a platform of bankable businesses to be able to scale such that we can be scaled later for us to invest in. What it does is that it provides seed funding, provides capacity building, and then also catalytic support to these businesses, majorly youth-owned businesses and women-led businesses. Now, that is not something that we have as a mandate that we can throw out there, but it is something that we decided to do as NSSF Uganda to be able to push growth within the country, so that, because if you look at it, if businesses are thriving, then NSSF is also thriving, because such businesses later become members and then later on increase our asset base. So small things like those can go a long way. Now, if we collaborated with different pension funds across Africa, that would now create a ripple effect all over the continent, because we understand how our businesses operate. And if we can be able to handhold them into a stage of them becoming bankable, because at the startup stage, most of these businesses are not bankable. The risk is too high for most commercial banks to touch them, to give them funding. So if you do small things like capacity building, give them some seed funding, hold their hands to the stage that they can now become bankable, later on you gain as an entire economy, as an entire nation. And those are some of the small things that we can do. So if we harmonize regulatory frameworks, for example, if you said no taxes for all pension funds investing across Africa, we already have a catalytic environment. So simple things can make a huge difference. And I believe if we are to collaborate and say that, you know what, we are setting up a cohort of pension funds or fund managers that are willing to push different agendas, then we can get to a point where we can now discuss. Because much as we love the continent, we also have a mandate to our member. So we have to be realistic and say that whatever risk we are taking on, we need the regulatory environment to be able to support the return that later comes down. Because I don't think you would be comfortable with me telling you, I'm giving you a 5% return on your investment because I invested, let's say, in a road, which is for Africa. It's a very good project, but as a member, they may not understand that, right? So if we have the environment that enables return to go in hand with the mandates that we have, I believe it goes a long way. So we need to work together.
Yeah, I think that cannot be overemphasized. Completely agreed with you. I want to shift to Mohamed as we come towards the the almost the middle of the questions. So Mohamed, on the sovereign wealth funds, they are actually built or structured to preserve wealth across generations. But they're also increasingly investing in African development. So they need to have a balance, long mandates versus the urgent growth that Africa needs. How do you think these funds can be able to do that balancing act? And from your work with sovereign wealth funds, what investment frameworks or models have you seen that have proven most effective, especially in aligning commercial returns against Africa's social and economic development priorities?
Thank you, Francis. As you might already know, I mean, pension funds, sovereign wealth funds, and DFIs can have a great catalytical impact. They can be also game changers if they collaborate strategically. For instance, I mean, if we talk about pension funds, they can shift allocations from government securities to productive assets like infrastructure, private equity, and green finance, especially through pooled vehicles and co-investment platforms. Same for sovereign wealth funds. I think they should also adopt a dual mandate, preserving wealth while, as you said, I mean, maintaining or investing in regional development, maintaining a balance between commercial gains and long-term development. Their long-term horizon makes them ideal for infrastructure and climate projects. And if we talk about DFIs, they can de-risk investments through first loss capital. In all our 9 funds, we have the DFIs providing the first loss capital in order to crowd in private capital. They also provide the much needed technical assistance. They engage in policy dialogues. All these are essential in structuring blended finance and aligning incentives. So together, those 3 actors can build regional investment platforms, like I've seen with Africa 50, AFC, AIF. They also should harmonize regulatory frameworks to enable cross-border capital flows and develop standardized project preparation tools to ensure bankability and transferability and transparency. Traditionally, sovereign wealth funds are usually, as you know, are guided by a mandate to preserve intergenerational wealth and maintain liquidity buffers. This is their legacy. But in Africa, where development gaps are immediate, as I said, in infrastructure, digital connectivity, climate resilience, there is a growing imperative to strike a balance in those sovereign wealth funds. The way forward is a portfolio diversification with a dual mandate, as I said, allocate a certain share of assets into domestic and regional productive sectors without compromising global investments or Pan-African investments. This does not mean, as I said, sacrificing prudence. Rather, it means structuring investments in ways that generate stable, risk-adjusted returns while delivering measurable development impact. For example, funds can invest in infrastructure via blended finance vehicles, where, as I said, where like our funds, where DFIs can take the first loss risk. They can also prioritize green and climate smart projects, which not only address development needs, but also protect long-term value by mitigating, for instance, climate risks. So the balance lies in broadening the definition of wealth preservation as defined by those sovereign wealth funds and pension funds. It's not just about financial returns for future generation, but also about preserving a livable environment and sustainable growth models. So in summary, sovereign wealth funds, as I said, they traditionally focus on intergenerational wealth and liquidity buffers, but Africa's urgent development needs require this dual mandate, preserving wealth while investing in productive sector. As I said, not sacrificing prudence, but structuring investments to deliver risk-adjusted returns and measurable impact. Blended finance vehicles like our funds, SANA, GGF, all our funds, where DFIs that take the first loss. This will allow the sovereign wealth funds to invest in green projects in infrastructure, climate, while mitigating risk. And finally, wealth preservation, as I said, should evolve to include environmental sustainability and resilient growth models. Thank you.
Thank you so much, Mohamed. I think I want to move before I just open it up to the audience. And Mohamed Amin, and I hope I've pronounced the Amin name well, asked a very important question. How do we ensure we align vision with execution so that this next generation doesn't just discuss these ideas, but drives them forward? I think if there was a significant question to be asked, that is the question. How do we move from pointing out the challenges, from showing the opportunities to actually execute? It's in execution that actually everything works. So, and I'll start with Tawanda. Looking ahead, the next 5 to 10 years, where do you see the biggest opportunities for collaboration? And what should be done in terms of executing that collaboration, starting literally today or before the conference or as part of this process? What would you say from this webinar, the next action point should be this, for us to move towards these big opportunities you'll tell us over the next 5-10 years of collaboration?
Thanks, Francis. I'm thinking pooled investments is going to be a good area. I think the big institutional investors need to come together. I think it's in the product development. And this is, I think, where the CFA charter orders are critical. If we are going to develop products that will give us the ability to pool funds for big projects with an African focus, I think that would be critical. I think we've known, if you check in Southern Africa, rail is a big requirement, but it's isolated to small countries that have small balance sheets that can't do that. So if there can be a fund that looks at transport and logistics, maybe at a regional level, where all of these, like what Mohamed was saying, where the de-risking is very, very clear. I think DFIs can take a role where they are taking the first loss, and, pension funds by nature, because sometimes they are risk averse, can come in when the investments have been de-risked. So I'm thinking pooling is a critical issue. One of the things also, I think our advocacy now needs to shift to actual participation in policy development itself. We need to start participating. We need pension funds to have a bit more flexibility. We know it's the restrictions that they are sitting on that's stopping them from participating in certain things. But if those could be opened up to allow so that regulators, start revising certain guidelines, investment guidelines, which they have set out there. And I also think, internally, we could talk about these things, but one of the major barriers to practicalizing or implementing is capacity itself. So we need, places where capacity building is prioritized, where, I think this is where the societies now become critical. How can we run programs where we are partnering with certain member institutions or key institutions in building capacity within the institutions? Because the institutions could be sitting on these huge funds, but their own human capital does not have the capacity to be able to execute. So how do we build capacity in these institutions? I think it's a critical thing that we need to look at. And also, generally, slowly, I think our mindsets need to start shifting now from, this short-term kind of investment philosophies to long-term. I was looking at China. Consider China, when the premier comes in, he has a 20 to 30-year vision for the country. And the way we ourselves as investors, as charter holders, participate in this investing process, do we really have a long-term mindset? Are we designing our structures and investment processes to allow us to consider divesting out of government securities for the purposes of trying to create infrastructure that will create employment in a certain sector? And that kind of mindset change and having a long-term vision is a critical aspect that needs to be built into these institutional investors. And the institutional investors act through us as charter holders. We are the ones who sit on those desks. So at what point in time are we going to then, advocate for different kinds of thinking where we are going to be the source of the change that we are calling for? Because for the longest, we will remain, bystanders, and we will always be suggesting things when we meet together. But really, the action needs to take place when we are in the places where we are supposed to be making the influence. And this starts by us capacitating the charter holders as societies, give them capacity, allow them to then go and execute when they have the opportunities.
Thank you, Tawanda. And you've touched a point that for me personally, I take very seriously. Our human capital is still very low, and the spread of the per capita charter holders, I call it, in Africa is one of the lowest in the world. And we need these professionals in the right places, in government, in policy-making institutions, so that this can be pushed forward. We've seen progress, of course, with, for example, what's happening in Ethiopia. We're seeing more candidates, we're seeing more charter holders. Rwanda has shown the way. We are getting the highest number of charter holders coming out of it. And this is happening across Africa, which is a good thing. I think I get your point that societies now need to figure out how do we make sure that we have more members in these policy institutions, and even members in those seats can actually be able to push for these changes. Which brings me to Josephine, and a question for you related literally to the same policy issue. If you were to recommend just one policy change or market reform today that would unlock most capital for regional or African growth, almost like the silver bullets, what should that change be? And I know it's a big challenge because I've said one. I'm sure your mind has gone through a number, so I'm waiting to hear that one.
Why are you giving me only one? I have like 5.
Give me 5, then give me the top one.
Okay, so the top one for me would be harmonizing the tax across the region, because that for me, when it comes to investment planning, is a major thing. And I feel like it's something that if policymakers were to sit down and critically analyze, they could do. They could harmonize the tax that is charged to pension funds. And I thank the East African community for making strides in that, because as NSSF, we enjoy the same tax treatment in Kenya and Tanzania as the locals. So if we can do the same across Africa, it would be a game changer, in my opinion. But I have others. Let me keep them for now.
Please give me 2 more.
The other one would be mandates for de-risking these particular projects. If you can in these projects, then I believe different players would easily invest in. For example, if you make a toll road and the government guarantees that if cash flows are not able to meet are not able to come out as projected, then it would come in to basically fill that gap. It would give investors more comfort to invest in these projects. And maybe the other thing would be, as you said, the human capital is still very low. There are very few people who understand how to actually make these investments and then go deeper to see what the results would be. So if our governments would mandate that maybe charter holders in these spaces where financial decisions are made, that would help us easily collaborate, because someone already understands what is needed. And aside putting the politics aside, they can be able to dissect the project to make sure that investors gain, but then also the country and the region also makes a gain from that. So human capital is the other thing that I would suggest. Thank you.
Thank you. Thank you so much, Josephine. And now to Mohamed. And after this, I'll just get some few questions from the audience and then close it out. Mohamed, for young professionals, and when you travel in at least for our East African countries, Kenya, Uganda, Rwanda, Tanzania, Ethiopia, even more so. There are very many young professionals and CFA charter holders and members coming up. What skills, networks, mindset should they cultivate to contribute meaningfully to the agenda of mobilizing African capital for Africa's growth?
Are you referring to the African talent, the CFA holders? Because is that the question?
Yes, pretty much. Yes.
What would be my advice? I mean, my advice would be threefold for the CFA young professionals. I would say develop structuring skills, embrace sustainability, and build regional networks. The future of finances Africa is about creating investable products that solve really local problems, embedding ESG into every investment, every deal, and also working collaboratively across borders. If the next generation can master these three, I think they will be at the heart of mobilizing African capital for African growth. So, as I said, my advice threefold. Develop structuring skills, learn how to build investable products that solve local problems, embrace sustainability, embed the ESG, environmental, social, and governance into every single deal, and build regional networks, collaborate across borders that will help mobilize African capital for African growth.
Thank you. Thank you so much, Mohamed. And I'd like to request, I know people have been patient. It's very hard sometimes listening through digital gadgets, but thank you everyone for having stood out. We are almost there. Grace, maybe you can put up the poll. In the meantime, I'll run through some of the questions, and to the panelists, just be ready. I may throw them to you impromptu. So Michael, given the growing number of venture studios and other venture building funds are those that have specific mandates for African health tech, who are the LPs or institutional investors? I think I'll take this one and say that most of the LPs actually you'll see is funding from outside. So funds, pension funds are mostly from outside. I don't think many of our pensions, at least in East Africa, Mohamed may tell us about North Africa having, I don't know, just when maybe you may touch on it, I don't think they've invested significantly in private equity and VC firms. And mostly, of course, it's on their mandate. You just put that one down, and then when I open it up for you, you can be able to touch on it, Josephine and Tawanda. This is Tunanuke Muganzi. Are there successful case studies or benchmarks in Africa on emerging markets that show that collaboration between pension funds and sovereign wealth funds and DFIs is working? I think those two I'm going to give Josephine, including this is NSSF open to investments in renewable energy infrastructure projects. So those three. Great points, Tawanda. Woohoo. I am in a remote area. Caleb Rukundo is saying is in a remote area and the internet connection is a mess, just emphasizing what you've said. But he has an issue, and his issue is around political risk and investment risk insurance as a service. And he believes it's a key enabler. How are you structuring these opportunities to encourage investment and at what cost? I think this one, Tawanda, just be ready for it, considering you've just been mentioned and you mentioned next again. You say that the investment in East Africa is not available for those in the West. I don't think that's what he said. Must have been a miscommunication. So that's not a question, Tawanda. How do you change the attitude of African investors to invest in different African countries to exploit more of our untouched resources for the benefit of the African youth? These are from Zerihun Arelso, and I'll give that to Mohamed. And then Colin Swanjira, how can regional collaboration of the capital markets help in growth of African markets? I think that has been touched on in one way during the discussions. And finally, Siongo Kisoso. Siongo, good to have you here. Welcome. To Tawanda, in your experience, which areas tend to show the greatest misalignment between national or regional development priorities and the mandates of DFIs? To Josephine, pension funds already have allocation allowances for alternative investments. which are critical for financing Africa's growth. Yet, these allocations remain largely underutilized. What do you think can be done to change this and unlock more capital? So, Josephine, I think you have most of the questions, so I'll open it up to you, then to Tawanda, and then Mohamed. Grace, maybe just put up the poll so that after that we'll talk about the poll as we have the panelists close out.
Thank you, Francis. The poll is already up.
Thank you, Grace. Thank you. Josephine?
Yes. The question is, NSSF open to investment in renewable energy infrastructure projects? Yes, NSSF is open to investing in different projects, but the key thing for us is risk, and I think that has held us back a bit, but we are open, and what we would like to do is to speak to the different stakeholders first, understand where they fall in the risk profile in terms of what our internal profile is, but we are open. The other question is, Francis, you will help me. To Josephine. Yes, pension funds already have allocation allowances to alternative investments, you're right, which are critical for financing Africa's growth, yet these allocations remain largely underutilized. What do you think can be done to change this and unlock more capital? You're right, we have allocation to alternative investments. And when you look at the pension funds, we are mostly on the supply side. We are financial investors. So the problem with alternative investments is that you need the other party to be willing to meet you halfway. So for example, if I give an example, let's say there's an infrastructure project that is that has been proposed, and the government says it needs this level of funding. So if us as a pension fund are willing to invest, we also need the government to show involvement, because at the end of the day, we don't have expertise to construct a road. We don't have expertise to run the tolls. You understand? Our expertise is limited to providing finance. Now we need the other party to also meet us halfway and show that they have expertise in actually implementing this project. So as much as we are willing, we cannot now go ahead and do everything. So we need that collaboration to come into place. And that is why investment in alternatives in Africa has remained relatively low, because there aren't a lot of projects that have that level of transparency and that level of expertise for us to be able to invest in. And again, this goes to the de-risking. If we can have maybe the World Bank or other institutions coming on board when we're investing into our project, that creates some level of security, and even the government providing guarantees. So that would go a long way in enabling us have the comfort to invest in, because at the end of the day, the member bears the ultimate risk of any investment that we make. What's the other question, Francis?
Yeah, I think those are the main ones. I may have mixed up my questions from up there.
Yeah.
So I'll just open it up to Tawanda.
Okay, thanks, Francis. I saw the one trying to scout out LPs. I'm sure this could be someone who has opportunities. I believe LPs are usually mandate specific. So if you have a product that fits a certain mandate for a specific investor, it could be a sovereign wealth fund, it could be an institutional investor. I mean, it's broad, but I believe most fund managers across the continent would be willing LPs to something that makes sense as far as they are concerned. So I suppose if you are very clear in terms of what you are trying to achieve, if it's of a national interest and is strategic at a national level for a certain sovereign wealth fund, you definitely get them as supporters and LPs for your opportunities. So I suppose this one is a very open one. It's a product design issue, if you were to ask me. And has anything ever happened with between sovereign wealth fund, DFIs, pension funds in Africa to create solutions? I've seen one. I know Shelter Africa is doing the housing one. This is a combination of a number of investors. They come to a particular country and you have a product that solves the housing problem. They tend to participate. So they either give you debt capital and things like that. So collaborations have been taking place, albeit I think the scale is what we are trying to address here. The scale has been relatively low. So it's isolated cases in a lot of places, and because most of the DFIs will not be able to carry all the capital requirements that we carry. So because some of these opportunities can only be exploited by some of the funds that pension funds are sitting on, sovereign wealth funds are sitting on. So it depends, are these pension funds really out there seeking to solve these problems? So if you're out there seeking to solve a problem, you definitely meet someone who's willing to collaborate. And I think the purpose of the webinar was to try and increase the levels of collaboration. You need to be on the market seeking to collaborate with someone for you to then find a collaborating partner. So I suppose that's critical as far as that is concerned. And I think the burden lies with us because we make decisions in those places. If we are not going to make the decisions that allow that to happen, then it could be a problem. Then the one sent out to me, one of the greatest misalignment between national and regional development priorities in the mandates of most of either DFIs, pension funds, or sovereign wealth funds is really, I think it's a question of being deliberate. Do these institutional investors really have an African problem which they want to solve? And we've seen that in most mandates, that doesn't exist. There is no mandate that's being designed that says we want to solve this African problem, and you have isolated it. And that lack of specificity or intent on the part of these institutions is what we are trying to then arouse and deal with. Can we, at least as we sit on those desks where we are making the decisions, be deliberate about it? We know, because we have discussed it. I think the conference is going to even discuss it more. There are African problems that need African solutions. Where I'm sitting, if I am thinking the same and you are on your desk, you are thinking along the same lines, chances are we are going to converge at some point in time. So we're talking about the idea of developing, pooled investment products. That can only be done when we, find ourselves having the same intent. So the alignment is really coming from intentions. There is no one who's seeking to want to do it. Largely because of governance issue, how the funds were set up and things like that. But I think it's a call to rethink. Can we rethink how we have set up these institutions, these structures, these funds? Can they look at Africa? Because I'm sure, a very big portion of the funds we hold as funds under management are crossing the borders. They are sitting in London, they're sitting in New York, they're sitting in, but I remember from my most recent conversation, a certain country's national bank had reserves amounting to $10 billion, and they wanted to lend it to a certain African country, and the IMF swooped in and said, you can't. So even certain infrastructure around us, can we have a convergence of monetary policy across the globe so that my worries of FX issues when I try to invest in Uganda or in Nigeria will be resolved because there's a convergence. And these are the things that are absent, even from a policy framework, that allow us to be able to take advantage of this. And the conversations won't take place unless we raise the issue and bring it put it on the agenda for conversations with policymakers.
Thank you. Thank you very much, Tawanda. And I think you've actually touched something Robert Katuntu has said, which is that charter holders need to follow example of other professionals and other accountants, lawyers to influence policy. These are long game, but we must start today. A quick win will be to submit memoranda before annual budget cycles. And you are very right, Robert. I think the approach so far with societies has been to influence mostly on the capital market side. And I think on that side, we've done a significant job. So yes, we need to start moving towards the central government side of things and making wider influences beyond the capital markets. I want to open it up to Mohamed, and then Mohamed, maybe the request I'll make is as you answer the question, you can also just give your closing remarks, and then we can look at we can get the other closing remarks and look at the polls. Thank you.
Sure. I mean, I need to answer the question. I think it's a very good question. How we should change the attitude of the African investors to invest in different African countries. I mean, that's a very good question. If Africans don't invest in African countries, who else would? I think it's a very important question, and for that to change the attitude, I think we have several things that we need to consider. First of all, that we need to reframe the narrative that investors look at in the African context from a risk to opportunity. So many African investors, unfortunately, they perceive the African markets as high risk, mainly due to political instability, currency volatility, regulatory uncertainty, which is usually a big problem. So we need to reframe that and present it to the investors as a content of opportunity, not just risk. Well, with 1.7 billion people expected to be the population of Africa by 2030, growing middle class, abundant natural resources, intra-Africa investment offers unmatched long-term potential. We have huge potential that can be unlocked. We see a lot of Egyptian companies, for instance, they are heavily invested in Africa and they're making very good returns. But we need to highlight those success stories. Like also, as I said, those Egyptian tycoon businessmen, like Swedi, like Citadel, like so many things, and as well as I mentioned earlier, AFC's Lobito Corridor, Africa 50 data center investments, and other regional investment and fintech platforms that build confidence. The second thing I would think of is also building regional investment platforms. We need to build regional investment platforms. This could be investment vehicles, cross-border investment vehicles that makes cross-border investments easier and safer. Again, platforms like Africa 50, AFC, AIIF, they offer those project preparation support, risk-sharing structures, blended finance models. So those platforms should be scaled and replicated to allow those pension funds that we were talking about, sovereign wealth funds, and other private investors to co-invest in vetted, impactful projects. And referring also to what Josephine said regarding the harmonization of regulations across borders, this is of paramount importance. Fragmented regulatory frameworks usually discourage any kind of cross-border investment. So a continental investment code, for instance, under the African Union, could standardize the tax treatment, protect investor rights, enable also pool the capital deployment. This would unlock billions of dollars in domestic capital, much needed for also regional growth. And I would say also mobilize youth-centric investment themes. So investors are more likely to act when they see a clear social return for their investments. We need to promote investment sectors that directly benefit youth and women, but mainly youth, given the very big population of youth that we have in the African continent, especially in education, green jobs, climate resilience, digital entrepreneurship. Affordable housing is also very important, and urban infrastructure. We need to use impact-linked investments to tie returns to youth employment, SMEs, as I said, green finance, or skills development, as well as foster Pan-African investor networks. It's also important that those African investors, they can engage in discussions, they can connect. So we encourage those platforms and networks can encourage collaboration through regional investment forums, joint ventures between African pension funds, knowledge sharing platforms, in order to build trust, reduce also this information asymmetry, because many African investors, they don't know what's happening in the other countries about the tax regimes, etc., but also create a shared vision for Africa's future. And last, I would say leverage the power of storytelling. So African investors need to hear stories, success stories, stories that had transformation, not just spreadsheets. And those stories that showcase how investments in one country has helped uplift the youth across borders. Use media, webinars, and conferences to amplify those stories and shift mindsets. So as a closing thought, if African investors, again, don't invest in Africa, who else will? The continent's youth are our greatest asset. And we need to look at them as an asset and not as a liability. And the best way to secure their future is to invest in the systems, infrastructure, and innovations that will empower them. Thank you. That's the answer to the question.
Thank you. Thank you. Thank you so much, Mohamed, for that. And as we go to Tawanda with his closing remarks, I want to recognize some of my board members on the call, and Maria from Tanzania. And also, I think I've seen, I've seen Anne Maria, and I've also seen Fasil. I think I've seen Fasil from Ethiopia. So I just wanted to recognize them. So Tawanda, maybe you can give your closing remarks. Then I'll also talk a little bit about the poll before we have it from Josephine.
Thanks, Francis. For me, I think this is a conversation that really needs a lot more time than just 1.5 hours. I'm thinking of how we can take things forward, as a body professional. And I think for me, the future really is in the young people. We need to actually ensure that they are building a skill set that allow us to exploit these opportunities. I mean, we are only beginning the conversation. By the time really things are in motion, we need to have the skill set. So young people need to be given an opportunity to build skills. We need to create a lot more platforms for networking. I mean, African investment professionals need to know who is sitting where and what kind of opportunities are sitting in which sector. And that can only be done if we broaden our networking platforms. I believe it's something we need to do. And for me, I think the value or the premium of the charter holder no longer sits on our ability to select assets. Asset selection is no longer the real deal here, but asset creation. We need to be at the forefront of creating assets that allow the ability to bridge these gaps that we are seeing at the moment. And we need to develop expertise in designing innovative blended finance models, new instruments that address specific market gaps. We talk of housing, we talk of healthcare, we talk of education. These are real African problems, and we cannot simply allocate to solve them. We need to create the solutions ourselves. So what kind of assets can we create? Do we think we have the requisite universe of securities to solve the problems or assets to solve the problems that are existing now? Probably not. I would say no, but we need to create the asset classes, the assets that allow us to do that. And I think, there's one thing that I noticed from one of the questions here that was asking about dual listing. Does it solve, our problems? I think dual listing is a symptom. The underlying problem is we have not made our environments comfortable enough for those to come. So US entities are not listing on the DAX for German investors to get access to them. They are going to the NYSE. So I suppose we also need to create that level of confidence and comfort for investors to come to the Nairobi Stock Exchange and invest without challenges. I don't need to take Safaricom to the London Stock Exchange for people to get access to Safaricom. They should come. And I believe those are the things that can only be done predominantly by the people that are on this platform. And if we are not seeing it as our duty and mandate to do that, then no one is coming for us. So that would be my concluding remarks.
Thank you, Tawanda. I think still blip. I keep saying no one is coming to save us, and we are the ones who can only save ourselves. I like your question of what do we do next? What can we be able to do to follow this one up? And for me, I believe we need basically action points or courses of action for this. And I'm hoping my team, Grace, Ruth, will be able to come up with tangible courses of action that will be able to put in play, and basically be able to also call the participants who are sitting in these sort of positions and can also be able to influence to also participate in these conversations. Thanks for that. Let me talk a bit about the poll before I have Josephine go next. Thanks, participants. These have been a very good participation. So far, 146 votes received. And the question was, which area do you believe offers the highest catalytic potential for pension funds and DFIs over the next decade? Infrastructure comes top with 68%. Then we have climate green projects, 36, fintech and digital. Actually, that comes second, fintech and digital, 42, climate green, 36, and healthcare and regional trade facilitation almost tying at 24 and 25%. So I think the conversation has touched a nerve also to just the participants that we need the infrastructure, we need the roads, we need the electricity in an affordable way, we need the internet. So we saw the challenges, and some of the participants have also been talking about it. That's one of the easiest way to actually unlock opportunities. I think we know of all the opportunities, and we should be very proud of what Ethiopia has done with one of the biggest dam in Africa. And for me, that's something that we as Africans need to be not only proud of, but see that it can be done. I hope there are participants from DRC here to just be able to see that actually River Congo can also be sort of harnessed for such opportunities. So allow me to open for Josephine for closing remarks. We are almost there, so just stay with us for another few minutes, please. Josephine?
Thank you, Francis. My closing remarks in how to turn this conversation into execution would be early engagement with the governments and getting their buy-in. Because if we align our strategic goals with the national development plans of the different governments that we are working with, then they can easily buy into what we need to do. It's very difficult to convince the government to de-risk your project when it's not part of their development program. However, if it's part of their development program and you offer them an option that instead of going to World Bank or IFC and getting expensive debt, I am willing to invest in this infrastructure project. However, I need some safeguards embedded in there. I believe the conversation would go differently. So if we can foster those conversations and get the government buy-in, we can go ahead to even influence regulations that can support our growth, not only of the charter, but then also of the region. So we need to be practical in how we tackle this. So if there's a project happening and you work for a pension fund, you can always engage them, get their buy-in, and it's a win-win for both of us. So that's my parting shot for this conversation, and I thank you all for listening and being an engaging audience. Thank you.
Thank you so much, Josephine. So to close it out, thank you so much to my panelists. It has been interesting and exciting. I'm very sure I'll be seeing you at the conference in December. And my summary would pick three things. There are many things, but I'll pick three. One, policy influence. We need to advocate more, not just talk, but start by small steps and advocate. And from the seats that we are seated on, the influence we have around, we need to start playing a role. Second is platforms, investment platforms, platforms which open up to regional opportunity. I'll also talk about collaboration, especially being able to make sure we align policies, we align rules and regulations and laws so that pension funds can actually start investing across. And finally, on human capital, the human capital has to be there. I think Tawanda has put it very well. Right now, technology can make many of the decisions we thought was giving us advantages. And now it gets to a point where we need to be the ones creating those opportunities, not just purely looking at trading on them. To the audience, thank you very much. Been very participative. I really appreciate that. I've enjoyed this, even though I'm alone in a room, but I've really enjoyed this. It was a very exciting one. We look forward to having you at the African Investment Conference this December, 10th to 11th in Nairobi. Please note that this conference happens once every 2 years. The first one happened in Nigeria, in Lagos. We're now doing it in Nairobi. And this is one of the unique conferences where you get all charter holders, members, candidates who are interested in Africa coming into one place. So we look forward to having you. We'll make sure that you enjoy African hospitality in Nairobi. And you'll also be able to enjoy the second day, which the team has planned very well. Grace, Ruth, Priscilla, and the team at the CFA Society East Africa admin, I really appreciate what you've done. Thank you so much, and we'll keep communicating to all members. Thank you. Have a nice evening. And if you are not home yet, drive home safe. If you are home, then enjoy your evening. We will ensure we action the points we put together. Thank you so much, everyone.
Thank you.
Bye.
Thank you, everyone.